Welcome to the Cardinal Commentary for the Foreign Equity Portfolio. After the S&P 500 quietly entered a bull market in June, stock markets around the world retreated during the third quarter. That shouldn't come as any great surprise, though, as September is traditionally the worst month of the year for stock markets. There has been strong growth in several sectors in the North American and global economies, such as hospitality, government, and healthcare, but others, such as finance and technology, are in decline. At the same time, new job postings are falling. There is some good news. For example, inflation is easing steadily. Core inflation in the US fell to 2.4% during the quarter. But portfolio manager Sheila Wilson-Cole says it's still too early to predict when central banks might start lowering interest rates.
We've seen inflation continue to decline over time, especially since peaking in June of 2022. In particular, the goods inflation has been decelerating. So for things like vehicles and durable goods, as well, even more recently, we're seeing some of the inflation come off the boil in terms of services inflation, including for travel. As well, a lot of the commodities, they've been declining. So things like lumber, copper, also a lot of soft commodities like wheat, so that will ultimately help when it comes to food prices at the grocery store. So things are improving and trending in the right direction, but there's still some ways to go on that front. The decelerating inflation is certainly helping the case for the central banks to stop increasing rates, but at this point in time, they're still saying higher for longer, and there isn't a definitive date when they will be potentially cutting rates.
Regardless of what's going on in the world, we own companies that lead the way in their respective industries. One of them, SAP, a German-based software provider, centralizes data and processing for its international customers. And those customers aren't going anywhere, according to equity analyst David Amy.
So we really like SAP because it has a sticky customer base. It's very costly and time-consuming for a customer to shift to a different software platform. We also like the recent shift to a cloud-based operating model. So this is increasing the recurring revenue for SAP. It's leading to improved margins. And it's also allowing them to cross-sell different solutions to customers. So these improved margins have allowed the company to grow their dividend at a 9.6% annual rate over the last decade.
We look for 8 to 10% dividend growth in our companies. So that puts SAP among our top performers in the foreign equity portfolio. 3 companies increased their dividends during the quarter. Honeywell at 4.9%, JP Morgan Chase at 5%, and Sony at 14.3%. They're not alone. So far this year, 20 of our companies have increased their dividends. Dividend growth plays a very significant role in long-term returns, and we're definitely seeing that as we outperformed the benchmark over the last decade. Here's the proof. If you invested $500,000 in this portfolio in 2002, it would be worth nearly $2.7 million today, outpacing the benchmark by more than $500,000. And why do we do all this? Because it works. And that's the Cardinal Commentary for our foreign equity portfolio. Thanks for joining us.